Hi, you guys. I'm Phil Town from Rule One Investing, and today I want to talk to you about the mistakes you should avoid in today's market. All right, we're all pretty well aware that a lot has been happening across the world these days. We're continuing to battle incredibly high inflation. We've got a war going on in Ukraine that's affecting the flow of materials around the world. Uncertainty is rising. Uncertainty is getting actually rampant. And we all know that uncertainty causes investors to make some very important decisions, particularly institutional investors. What I want you to do is be sure you understand the real problems that are out there and then how to avoid the mistakes people are making. So we're going to go over 4 big mistakes I see a lot of people making right now and how you should avoid them. Now, if you're curious about additional investing mistakes to avoid and what you should do instead, just download this list I've got of 10 do's and don'ts. Do it at the link below. And then let's just jump right in. What should you specifically think about in today's market? All right, well, the first thing is that most investors, advisors, financial advisors are going to give you the stock prescription for every single market drop they have ever seen in their lives. Every single one of them. It doesn't matter if the end result is the market dropped 90% in 1929 or 55% in 2000 or 50% in 2008. It doesn't matter. They're going to give you the same advice, and that is don't panic. Just stay put, it'll recover, despite the fact that the proof over 100 years is that the market can take years and years to recover. And in fact, the difference between actively investing and managing your money in a major market meltdown and simply being a head in the sand investor and just praying that everything works out can be triple your overall dollars 5 or 10 years later, even if all you're doing is just putting money in mutual funds or indexes. Triple if you actively manage it. So the first thing to do is to avoid listening to those sirens that are out there telling you, don't worry about your ship going onto the rocks, it'll all be fine. What they really mean is, be sure you leave your money with me. I will be happy to take care of you. So this is a really tricky time right now because the market's already started to tumble a bit. But I will tell you right now that we started getting in cash a while ago. And if you've been watching these videos, you probably already know that. So best to be prepared because about every 10 years or so, we have a giant economic storm. And when that happens, it rains gold for a little while. Unfortunately, most people are not able to go out there and collect it because they've got all their money already in the market. And that's exactly what went down. So they don't have any money. They got half the money they had before. Do not sit here right now and assume that this market will keep doing what it's been doing the last 13 years. Very unlikely that that will happen. The Federal Reserve is intending to throw us into a recession. They're hoping they can do a little recession, not a giant recession, but there's no telling. It's like walking a tightrope across Niagara Falls. They can very easily fall off on the side of letting inflation get out of control or tightening up too much and just jamming us into a big recession. So the best thing for you to do right now is to look at what you own and understand it. If you can't do that, you are just gambling in the market. So I'd say right now, be a big time to really make sure you know what you're doing out there. Look at the companies that you already own, see if you can figure out what they're worth. And by the way, Rule One Investing will teach you how to do that in about 3 days. And then get out of the ones that are already overpriced. All right, only keep the ones that are cheap already. All right, second thing, you should avoid investing in bonds right now. This is a very bad time to be putting money in bonds. The interest rates have been insanely low for an insanely long time, and it's very likely that they're no longer going to continue that as the Federal Reserve tries to slow down inflation. What that means is they are going to use the major tool they have to raise interest rates, force them up. Some of you already realize that interest rates on mortgages have already almost doubled. So that just can happen so fast. And yet, even at 6% mortgage rates, those are historically low. When I was selling my first house, we were in the midst of a major mortgage price increase from the last time we had major inflation. And mortgage rates went to 14 and 15%. In fact, the guy that bought my house got a 14% mortgage. So right now, 6% still looks good. It only doesn't look good compared to what it's been, which is historically low. So we could see interest rates go much, much, much higher. You don't want to be in long bonds when this is going on. Bonds are going to be really suffering right now. Now, another key thing to avoid is being in companies that don't have a moat. That means you're in companies that are actually fragile. There's an old saying that when the tide goes out, you get to see who's swimming naked. And that really applies to a recession. When the recession happens, the companies that don't have a strong moat will have to lower their prices to compete. And we're starting to see that already. Prices going down on major marketers that have too much stuff to sell. They're going to get rid of it by lowering prices. And what that means is that if you don't have a moat in your company's going to have to lower prices as well, squeeze the margins. Ultimately, if you have a lot of debt, you could go under here. So we want to make sure we've got companies with big moats that have the ability. What a moat does is give you competitive protection, and that gives you the ability to raise your prices with inflation. So as your costs go up, you can raise the price. So if Coca-Cola's cost of sugar goes up, that's okay. It can raise its cost to the consumer by a nickel and cover those extra costs. So this is a really important thing as we go into recession. Make sure you got a moat in those businesses. Okay, and lastly, you should avoid currencies that are getting devalued rapidly. The US dollar got a huge devaluation in the last year or two with all the money that we printed. But amazingly, it's stronger than it has been in a long time against the euro and the yen, because those guys are also printing money as fast as they can. So this is just this gigantic experiment of fiat currencies. We'll see how long it goes forward and see what happens. But in general, just the advice I've got is try to get your money into real assets that have value, that produce value. Warren Buffett just bought a huge block of Occidental Petroleum and Chevron, buying oil and gas, something that's real that people have to have. So be careful right here. You want to be sure you're investing in something that gives you the ability to ride with inflation, and currencies are not it. All right, so those are 4 real big tips right there. I'd love to hear from you guys. What are you doing to avoid problems in this stock market? Leave a comment below, and I'll be sure and answer and follow up with you. And thanks for watching. Now go play. You guys, if you enjoyed this video and feel it was valuable in teaching you more about investing mistakes you should avoid in today's market, hit the like button, and please share the video with your friends. If you want more investing content, subscribe to my channel. Don't forget, click the button on the screen, got a free gift. Thanks again for watching. See ya.